Setting entry and exit points in trading is crucial for maximizing profits and minimizing losses. An entry point is the price at which a trader decides to buy or sell an asset, while an exit point is when they close the trade to secure profits or cut losses. Choosing the right entry point involves analyzing market trends, support and resistance levels, and using technical indicators like moving averages, RSI, and MACD. For instance, traders often enter a position when the price breaks above resistance or when an indicator signals a trend reversal. Similarly, exit points are determined by setting profit targets or stop-loss orders. Profit targets allow traders to exit once a certain level of profit is achieved, ensuring they lock in gains. Stop-loss orders, on the other hand, limit potential losses by closing the trade if the market moves against their position. Successful traders also use risk-reward ratios to decide exit points. For example, a 1.2 risk-reward ratio means risking $100 to potentially earn $200. This approach helps traders maintain profitability even with a lower win rate. Another strategy is trailing stops, which adjust the exit point as the market moves in favor of the trade, protecting gains while allowing the position to grow. It's also essential to consider market volatility when setting entry and exit points. In highly volatile markets, wider stop losses are often needed to avoid premature exits. Additionally, psychological factors play a significant role in setting exit points. Greed and fear can lead to holding on to losing trades or exiting profitable ones too early. To avoid this, traders should follow a disciplined approach and stick to their trading plan. Using a combination of technical analysis and a well-defined strategy enhances the accuracy of entry and exit points. For example, a trader might wait for a confirmation signal, such as a candlestick pattern or a crossover of moving averages, before entering a trade. Likewise, exiting at support or resistance levels can help maximize profits. It's also beneficial to analyze previous trades to learn from mistakes and improve future entries and exits. In binary trading, setting precise entry and exit points is even more critical due to the fixed expiration times. Traders need to be highly accurate in predicting short-term price movements to succeed. Overall, setting entry and exit points requires a balance of technical analysis, market awareness, and emotional discipline. By planning trades carefully and setting realistic goals, traders can increase their chances of success while effectively managing risk.